Good day, students, and welcome to a very unique lesson where we're going to be going over different financial vocabulary terms that are going to show up in our financial unit. So basically, all you need to do during this video is in your notebook, you are going to set up a notebook page and title it financial vocabulary. And then I just want you to write down, there's going to be a category. So like we might be doing like budget or interest or shopping or something like that. So just write down like the category as like the new, maybe a section in on your notebook page. And then you're just going to write down like a bullet point, the vocabulary word, and then the definition of the word. If you want to like draw a picture or something to help you or write down an example, you're more than welcome to add additional stuff, but pretty much what you see on the slide, the vocabulary word, the category, and the definition are really all you need to write down. So let's get started. We're going to talk about some what I call account terms. So if you just want to write like account terms, and then underneath it, you're going to just put bullet points with these vocabulary words. So the first is a savings account. So a savings account is just an account that's meant for savings. It's not meant to have money that's spent. Pure and simple, that's all it is. A checking account, on the other hand, is an account that's made for spending or expenses like your bills, your payments, things like that. And a lot of times a checking account is connected to a debit card. If you're old school, like my parents, my boomer parents, they use checks. They write checks with their checking account. So that's meant for money that's spent. A lot of times that's like when you get paid from your job, your money goes in your checking account and then you can put it into your savings account and things like that. Some other terms that are really important. Oh, by the way, if I'm going too fast for you to write down, you can just pause the video. And then when you're ready to move on to the next slide with me, you can unpause the video. So if for whatever reason you did not get this written down, go ahead and pause to copy it down. And then we're going to move on to the next slide. Okay, so we're going to keep going with some account terms. So this should still be in the same section of your notes. So a withdrawal is when you take money out of your account. So if you need money to pay something or if you need cash, a withdrawal is when you take money out of your account. The opposite of a withdrawal is a deposit. A deposit is when you put money into your account. So sometimes like you can put money into your account, but then also, maybe a family member could put money into your account or your job. A lot of times jobs have what's called direct deposit, where your company or whoever you work for directly deposits money into your checking account. So like in AISD, they directly deposit my paycheck once, twice a month, depending on the school year, into my checking account. The other thing that's important to note is your account balance, or the word balance. So the balance is how much money is in your account. And if you are not good with your money, the balance could be negative. That could happen. So you want your balance to be positive and you want it to be as high as possible, right? Because we want to have money for days. So these are all of our what I call account terms. The next section is what's called budget terms. So a budget is basically a financial plan for spending, savings, and expenses. So you get money from certain different areas, whether it's your job, whether it's your family, but you also have things that you might need to pay for, like either when you go shopping or when you have things like if you ever have to pay rent or pay for your cell phone, stuff like that. So a budget helps you figure out where all of your money is going to go. And most of the time, people who are rich or who would be considered like financially stable, they tend to have like a budget and they stick to the budget. That's the other thing. You want to stick to your budget. Okay. Also, in terms of a budget, there's something called income. So income is just money you earn from a job. So I am a teacher and I earn my money from being a teacher. Do I earn enough money? No, but that is another discussion. Okay. You can also have what are called fixed or variable expenses. So expenses are things that you have to spend your money on. A fixed expense is an expense that pretty much is always going to remain the same. So like if you live in an apartment and you have to pay rent, a lot of times your rent is going to stay the same every single month. If you have a car payment, a lot of times that stays the same every single month. So a fixed expense is an expense that's pretty much going to stay the same from like month to month, week to week, whatever the timeline is. A variable expense is something that could change over time. So one thing that's like really popular in terms of a variable expense is electricity. Like we use a lot of electricity in the summer here in Texas because it's super hot and we need air conditioning. But like we don't use as much electricity in the winter because it doesn't get quite as cold unless it's like one of those crazy years where we have like the freeze and stuff. So like your electricity can vary from month to month. The amount of water you use or gas in your house can vary from month to month. Sometimes like your cell phone bill can vary if you go based on like minutes versus like a fixed plan. That one could kind of be either or. It could be a variable or a fixed expense. How much you spend on groceries could change every week. How much you put in your savings could change. That you probably want to have as a fixed expense, but sometimes like you may need to spend more money on something during a particular month and you don't have as much to put in savings. So that's the difference between fixed and variable expenses. Okay, our next section is going to be about interest. So the first thing you need to know is that there's good and there's bad interest. So good interest is money that you earn on like a savings or retirement account over time. So just by putting money into an account and not touching it, you can earn extra money. So it's just money that sits there and like, after so many years or so many months, like maybe you have another like $5 in the account or maybe $100, or after so many years, maybe there's like $1 million, like something crazy. So that's good interest. It's just money that accumulates in an account over time. Bad interest is the money you have to pay just for borrowing money. So, for example, if you borrow money, let's say to buy a house, or a credit card is essentially you borrowing money. That's not money that's tied to your bank account. If you don't make your payments back on money that you borrow over time, banks or credit card companies can add interest, meaning you didn't make your payment on time. So you not only do you have to pay what you spent or what you owe, but now you also have to pay us extra because you didn't make your payment to our company or you didn't make your payment to our like loan or whatever it is. So that's bad interest. So when people like go buy a house, they always look to see what the interest rate is, and you want the interest rate like on your house or your credit card to be super low because you don't want to have to pay back a lot of extra money, right? But when people put their money into an account that earns interest over time, you want that interest rate to be high because you want as much extra money as possible in those savings and retirement account over time. So that's the difference between good and bad interest. Other things that are important with interest, there's two kinds of interest when we're talking about good interest. So interest that accumulates in a savings or retirement account over time. So one of the types of interest is called simple interest. So this is interest that can only be earned on what's called the principal amount. We'll talk about what that means in a moment. And then there's something called compound interest. So compound interest is when interest is earned not only on the principal amount, but also on any extra interest. We're going to do a whole video on simple and compound interest and how to calculate it. So I'm not going to get too much into detail with this. So just go ahead and make sure you copy down the definition. And when we do the video, I'll show you the formula and explain it a little bit more in depth. However, when we're calculating interest, there are going to be some variables, some letters in our formulas that are going to be really important. So you're going to see the letter P, which stands for principal. Principal is the amount of money that you start with. So that's the amount of money that's like in your account or that you put in your account to begin with. That's called the principal amount. Rate is the interest rate, and it's normally given as a percentage. So like 3%, 2.5%, so forth. And then time is going to be the length of like your account. Like how long have you had this account, or how long has this account been earning interest? And we always measure the interest in years. So sometimes our problems will tell us in years, like, oh, 5 years, 7 years. Sometimes though, they'll make it complicated and they'll say, 36 months. And we kind of have to do the calculation of like, okay, well, how many years is that? So that's just something to keep in mind too. But these three things, principal, rate, and time, are going to come up in our interest formulas when we talk about how we calculate interest in a separate video. Okay, the next category is all about spending. One of my favorite things to do, spend money. So one thing that does occur a lot of times when you spend money is you have to pay a tax. So a general tax across the board is any additional cost paid to the government, based on like your income, business profits, or sales of goods and services. So there's three kinds of taxes. There's business tax. So that's tax that like companies have to pay to the government. There's tax that you might have to pay based on your income. So like, you can earn money from a job, but then you have to pay the government taxes. And taxes, a lot of times from the government, are used to do things like pay for schools, like public education, the roads, that kind of stuff. But you also might have something called a sales tax. So when you go to the store and you buy something, you don't just pay for what you buy, you have to pay an additional amount called the sales tax. There's also some things when we're shopping that you might notice, such as a markup. A markup is an increase in price by a dollar amount or percentage. There's also the opposite. There's a discount, so a decrease in price based on the dollar amount or percentage. Obviously, when we're shopping, we would rather have things on discount than things that are on markup, but those both exist out in the shopping world. The last category is going to be something called net worth. So net worth is the value of a person's assets minus liabilities. So one thing, if you want to do just for fun right now, is pause this video, but wait till you hear what I'm going to tell you, then pause it. Pause this video and go, like, think of like your favorite celebrity, famous person, athlete, musician, like, I don't know, someone you jive with. For me, I would obviously pick like Taylor Swift. Okay. Google that person's net worth. So like go Google Taylor Swift net worth or LeBron James net worth, and you'll see a dollar amount come up. Okay. So take a moment, pause, and do that. Okay. Now that you're back, that person's net worth. So let's say we looked up like Taylor Swift's net worth. I have no idea what her net worth is. She's currently on the Eras tour right now, so she's probably making a lot of money. Good for her. She deserves it, my queen. Okay. Anyways, her net worth is all of the things that she owns of value minus all of the things that she owes money on. So an asset is an item of value such as a car, a house, things like that. Liability, on the other hand, is stuff that you owe money on. So like if you owe money on a house, you pay what's called a mortgage. That's kind of like the rent for a house that you own. Or like, let's say you have a loan out, like you took out a student loan to go get your degree or something like that. So your net worth is how much money you're worth based on all of the things that you have of value minus all of the liabilities. So any loan payments, credit card payments, mortgages, things like that. So the higher your net worth, then obviously that means, the more assets you have in comparison to your liabilities. So the way we calculate someone's net worth is we take all of their assets and then subtract the amount of their liabilities. This brings us to the end of our presentation, I guess I should say. I'm sorry if I was a little unhinged in this video. I'm just super jazzed to talk to you guys about financial things because this is something that a lot of times you don't learn about in school. I didn't learn about a lot of these things until I was much, much older. So I think it's really great that we're starting to get some exposure to this right now in middle school at your age. So if you need to go back and refer to any of the slides, you're more than welcome to rewind. Make sure you have all of the definitions written down and make sure you maybe mark this page like dog ear the corner. So that way when we're going through other videos, like we have full videos on net worth, we're going to have full videos on taxes, interest. You can refer back to this page when I discuss a term, but don't go too in depth with it with the definition, just so you can remind yourself what the definition is. I hope you guys have a great day with whatever you are doing, and I will see you soon. Bye.